Hello and welcome to our valuation of Deutsche Post AG. In this presentation, we will guide you through the profound valuation according to the discounted cash flow method and the multiple method of Deutsche Post. I hope you will enjoy it. Hello and welcome. In the following video, our team is providing you with the profound valuation of Deutsche Post AG according to the discounted cash flow and the multiple method. We will describe all the analysis in detail. If you still have questions, please feel free to ask us. Enjoy.
Deutsche Post reports four operating segments to reflect the group's predominant organizational structure. Starting by Post e-commerce parcel is a division that handles both domestic and international mail and is a specialist in dialogue marketing. Regarding to Express, it offers time-definite courier and express services to business and private customers. After global forwarding and freight, it comprises the transport of goods by road, air, and sea. Finally, supply chain delivers customized supply chain solution to its customers based on globally standardized components including warehousing, transport, and value-added services. Since December 31, 2015, the KR is 2.69%. Current share price is 26.03 euros. Deutsche Post has been investing in new technologies such as pack stations, which provides automated booths for self-service collection of parcels and oversized letters, as well as self-service dispatch of parcels 24 hours a day, 7 days a week. Parcel boxes and in-car delivery services are some other examples of innovations. We know that the company is also developing a broad portfolio of online products and services, such as All You Need Fresh. There is an online supermarket. Regarding our peers, we used 5 criteria to choose the companies. We can see that in most of the cases of the companies have a high degree of comparability. Publicly traded, business description, comparability of markets, comparability in size, and overall comparability.
To analyze the historical performance of Deutsche Post AG, the balance sheet and the P&L are evaluated. To analyze the balance sheet, it is restructured based on the net assets method. Here, fixed assets, net working capital, net debt, and other assets and liabilities are determined. For a detailed classification of all balance sheet items, please refer to the Excel file we are delivering with this project. By summing up these balances, the net asset sum is determined. If this net asset sum equals equity, it is proven that the classification and calculation has been done correctly. The stated increase in the net assets is mainly realized by the decreasing net debt for around 500,000 euros over the period under review. Conversely to this decrease in debt, a sustainable increase in the other drivers has been realized. The analysis of the P&L is split up by the investigation of revenue drivers and the costs separately. The PEP driver is increasing strongly due to the usage of online platforms like Amazon or Zalando. In addition, after companies find out that sending advertisement per mail is not effective since mail are filtered in the junk folder anyways, companies more and more refer back to commercials sent to the consumer per post, which is also considered here. Finally, the post service itself experiences a decrease due to the fact that people nowadays prefer online communications. However, the decrease is compensated by the planned sale of Postcon next year. This merger is expected to weaken Postcon as the target's biggest competitor significantly, which provides the target with the opportunity to generate more sales here. In addition, express services are PEP services performed in a shorter time frame for which the customer pays extra. Here, the demand is increasing as well. Global forwarding and freight faces a slight decrease in revenues due to strong competitors in the world market. However, the target plans to invest here as well to increase the generated revenues again. If the supply chain driver, the target plans to increase revenues in the future as well, which will require investments too. However, the target has been able to maintain a constantly growing revenue of 23% of the total revenue here. By analyzing the cost drivers, it is recognized that the target is able to realize a strong increase in its net income margin in the period under review, which of course represents a favorable trend for a potential investor. As for almost all service companies, cost of goods sold represent the main cost driver. They consist of material and staff expenses. Due to the target strategy to invest in automation, it has been able to already reduce the amount spent on staff by replacing it with a cheaper usage of machines. As a result, the target was able to reduce COGS by 2.3% in the historical period. Next to this, OPEX remained relatively stable over the period and is going to remain constant as well in the future. Finally, depreciation plays an important role here. As the logistics business is relatively asset intense by making use of trucks, ships, planes, and so on, the target has found a way to keep the depreciation probably resulting out of this usage low. This revenue and cost strategy has enabled the target to generate an increasing profit margin in the historical period. The weighted average cost of capital, or WACC in short, is used to discount the future free cash flows of the target back to their present values under consideration of their risks. To do so, the cost of equity is calculated under the consideration of the factors and according to the method described on this slide. It is identified that the target has costs of holding equity of 8.16%. Next to this, the cost of holding debt are calculated of course as well. Based on the yield of the most recent 10 years bond of the target has cost of 2.75% to hold this debt. This is multiplied by 1 minus the corporate tax rate to take the tax sheet into consideration that results out of this. Finally, the cost of equity are multiplied with a proportional share of equity in the target's capital structure and added to the product of the cost of debt and the corresponding proportional share of debt. As a final result of this analysis, the target faces a weighted average cost of capital of 7.35%.
As to the business plan and under the assumptions we are going to explain in the next slide, we forecasted an increase in sales over the 5 forecasted years from 2018 to 22 for each of the business segments. We can see an increase of almost 25% in sales from 2017 to 22, which derived an increase in gross profit of almost 39%. This shows a rise in the gross margin of almost 2 percentage points over the period tested. As to the net profit margin, we can also observe an increase of 60% from 18 to 22, going from 4.65% to 6.02%. Having this said, we expect Deutsche Post not only to increase their sales, but also to improve their margins over the next years. As to the assumptions made for the business plan, we based our opinion on the strategy followed by the company and tried to frame it into several industry reports and sector news. It is also important to refer that every statement was adjusted for the expected inflation. As to the sales assumptions, based on our insights, we expect every business to grow over the next years, as we believe they are going to keep with the market. Exceptions were made for post business, as it is believed to decrease, mainly due to the digitalization of official mail, which represents the main sales driver of post business. This decrease was also slowed down due to the expected sale and downsizing of the main competitor, Postcon, in 2019. As for the cost assumptions, and according to the company strategy of focusing more on automation of processes in the future, we expected materials to increase their weight in every year in the cost structure and the decrease in staff.
Based on the previously explained business plan, the target generates an increasing NOPAT in the business plan period. By considering the described calculations and also accounting for the change in net working capital, the maintenance and investing capex and the depreciation, the free cash flow is computed and discounted by applying the previously calculated WACC. This total discounted free cash flow is then combined with a terminal value, which identifies the value of the company after the end of the forecasted business plan period, under the going concern assumption. As a result, the target's enterprise value of 68,902,000 euros is determined. To define the equity value, the previously described net debt amount is subtracted together with the other assets liabilities. In the last step, then, minority interest is deduced, as it has been consolidated in the reported income statement, but however does not belong to the investor or equity holder because it is only resulting from a minor share in other organizations, which should not be consolidated. As a result, the equity value of 58,338,000 euros of Deutsche Post AG is identified based on the discounted cash flow method.
We analyzed 4 different multiples in order to critically assess our DCF-based valuation. Specifically, we took EV/EBIT, EV unlevered free cash flow, EV sales, and price to earnings per share, and thereby NTM and LTM multiples. We consider NTM more relevant as it takes future market expectations into account. Amongst the multiples, we consider EV/EBIT to be most relevant, as it is not falsified by capital structure and national tax differences, but takes depreciation and amortization into account, which play a significant role for a capital-intensive business, such as logistics services. Regarding all EV-based multiples, we derive the equity value by deducting the equity bridge, which is shown on the right-hand side of the slide. The equity bridge consists of net debt, net working capital excess or shortfall, which is different from the DCF-based equity bridge, minority interest, and other assets and liabilities. Our multiple-based valuation results can be obtained from the table as well as the graph, shown below section 2 and 3 on this slide. In order to get an idea of our valuation results, the graph is most convenient to look at. The graph shows a comparison of our DCF and multiple-based valuation results. We can see that in particular EV/EBIT NTM, highlighted in blue, which we consider the most relevant multiple, is well in line with our DCF-based result. Finally, we come to the conclusion by summarizing and critically assessing our results. We undertook a DCF valuation of Deutsche Post by forecasting the main service lines as well as cost factors through industry and company-specific research. We then confirmed our DCF through several multiple methods based on a selected set of industry peers. The deviation between the different multiples and the DCF valuation can be seen on the first graph to the right. As explained previously, we consider EV/EBIT NTM the most relevant multiple, and the deviation of our valuation result based on this multiple and the DCF is extremely small, which we interpret as a strong sign of accuracy. Regarding the share price, we obtained a value of 47.93 euros, which is significantly above the last closing price of 26.03 euros. However, one has to keep in mind that we made our calculation based on the numbers of the 31st of December 2017, and the share price on this date was 39.75 euros, which is much closer to our valuation. Furthermore, the EV/EBIT NTM multiple is below market average, as it can be seen on the second graph to the right. This also indicates a low valuation. Based on this rather low market valuation and the overall positive future business outlook, we conclude a strong buy recommendation for the shares of Deutsche Post.